Hello value investors, thank you for joining me. Today I want to talk about how I find stocks. So this is a question that comes up to me all the time. People say, Michael, how do you find stocks? So whether you are a novice or you have had a few years experience, I believe that this video is quite helpful. If you're new to the channel, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why. I have a hybrid portfolio with a combination of high growth stocks and low growth stocks, what people traditionally call value stocks versus growth stocks. So hopefully you'll find something that suits you. So welcome, do a free trial. Also, don't forget to subscribe to the channel so you can get my next value installment. So I'm going to break up the video into 3 different parts. Firstly, we're going to talk about screeners. Secondly, we're going to talk about how to get to know as quickly as possible. Then I'm going to talk about 2 key metrics to really think about whether, even if you're going for a low growth stock or a high growth stock, just to kind of balance you out. And lastly, for more advanced investors, I'm going to talk about themes. So let's get started. So when it comes to doing a screen of stocks, I think that the best way to go about it is to get the market cap at the high end at approximately 20 billion and the market cap at the low end at approximately 500 million. That gives you quite a lot of stocks. I'll give you more than like 1,000 stocks or so. And ideally, you just want to kind of lock out a day and just try and kind of get through something like 300 companies within the day. It's going to be a bit mind-boggling, it's going to hurt a little bit the mind, but the game is essentially what Warren Buffett was doing when he was starting out. He was going through the Moody's manual. We don't necessarily do that, the screen is available to do that. But the game here is to, as quickly as possible, get to know. Reasons to get to know could be that the company is revenues are consistently declining for a decade, too much debt, easy out, doesn't make any free cash flow, no potential making free cash flow. So these are very quick rules of thumb. So you just want to go bang, bang, bang to try and get through to know as quickly as possible. My advice is that if it's something that's kind of interesting, at this point, don't spend any more time on it. Just put to a side, take a name, just to possible. So you just want to kind of whittle it down till you got about 50 companies kind of interesting. Within those 50 companies that you may have, just spend a couple of minutes going through the 10K. Read over, just very briefly, look at the auditor's report. Just go for the investment risk, just to try whittle that down. You're trying to basically just get to know. The point of investing is to be very selective. So it's very interesting because there are 2 characteristics that really drive forward strong returns. A person has to be very patient, but the person does also have to be able to execute in a sufficient manner by weighing the portfolio adequately when the probability of success is slightly higher than the probability of failure. Now, this is the key, I believe, to investing. It is not to try and find moonshots. You're not trying to find a 50 million market cap company that can double overnight. That is, that's what I call the zero-sum game. I've got a video about the zero-sum game, that it's essentially a speculation. The person will have a lot of winners, but then you'll have a lot of losers. Ultimately, the winners and losers balances out, and that's the market. So you can't consistently do that for a prolonged period of time. A much better idea is to have in your mind, okay, I'm looking for companies that can double in 3 or 4 years. That's much more achievable, and I think that's a more realistic way to go about that. When it comes to the balance sheet, just double check the balance sheet. Just see that on current liabilities, just check that over the next 12 months, so that's the current liabilities, that the debt is not significantly higher than the cash, because if it is, the company may struggle to pay that, and that's why the stock is cheap. So the game here at this stage is just whittling it down, whittling it down, whittling it down. Once you're down to, let's say, approximately 30 companies, depends on the strategy you're going for. Historically, people say, oh, that's a value stock and that's a growth stock. Now, I've got a different video on that, and I don't think that's very helpful. I think that all investing is value investing. Essentially, the investor is making a valuation and assessment of what that asset or that company can be worth in the future. The investor is deploying capital today for something that can be worth substantially more 3 or 4 years out. So it doesn't make too much difference at this stage in the game whether the share price is moving up or down. In fact, I believe you actually much better to do away without even looking at the charts. I don't even bother with that. In my mind, I'm just trying to figure out, okay, I don't even look at the share price, I just look at the market cap. I'm just trying to figure out in my mind, okay, market cap is, let's say, 5 billion. What can 5 billion? Because if you buy a share, you're the share owner, you're the business owner, you're the owner of that company. Is the same as you buying the whole company. So I'm just trying to think, if I have 5 billion and I deploy it into XYZ stock, what will 5 billion get me elsewhere? So that's what I think is quite helpful, because looking at the share price kind of messes with your mind a lot. Or if the share price is falling, I don't want to get involved. Share price is going high too quickly, it can be overextended and I don't want to run after it. So I think that that's actually really that's just counterintuitive and doesn't help you. I think that a slightly better way is to look at the market cap and try to figure out what the business can be worth in 3 or 4 years time. So when it comes to those metrics that I think are quite helpful, if you have a low growth stock or a high growth stock, what the characteristics are the same. You're looking for a stable business. That's the starting goal. So by a stable business, you should be looking for margins that are quite predictable. If you have a more mature, low growth business, the margins have been maximized already. So you just want to see that over the period of, let's say, 3, 4, 5 years, the margins are quite replicable. Start at the gross profit margin and look at just how much they're spending on SG&A. It shouldn't really diverge too much in a low growth business. A low growth business should be something that kind of makes around 5-8% on the top line growing around. So you don't want to go in something that has no growth, because that's difficult. I mean, it's going to be a difficult game, that one. You want to be into something that has consistently growing by mid-single digits. So, 5-8%. And in that case, you don't really want to be paying too much more than, let's say, 8 times free cash flow. Remember, the low growth business has already gone through its growth cycle and now it's maturing out. So it's a stable business, quite predictable. You can very easily figure out what that business can be doing in 3-4 years. So you kind of want to pay a multiple to free cash flow in that instance, because the business has already been generating a lot of free cash flow. So that's for the low growth business. For the fast growth business, my advice here, because everybody's playing the same game, everyone wants a very attractive, high flying business. And I'll come to the metrics there in a second. But before that, I think it's worthwhile to mention that what makes for very difficult investing is the middle. People call it growth at a reasonable price, GARP. So that is where I think a lot of people trip up, because with the GARP, it's a business that is no longer growing. It's growing at, let's say, 15-18% year over year, compounded annual growth rate, and your person's paying, let's say, 40-50 times sales. That's crazy, and I think that's difficult. So when it comes to a high growth business, you really want to see into next year, even if things were to kind of more or less hit the fan, you want to see at least the revenue growth rate at least 30%. Because if this year right now it's already at 30%, out to next year, most likely because of the larger base of revenues, it's going to decelerate. So it's going to decelerate, let's say 26 maybe, things go kind of a bit haywire, goes down to 22. That's already going to get a bit difficult. So you don't want to get that type of investment, because that's a crowded space. And I think that in this market right now, everything is so overhyped and just the price is so extended, it's difficult to find a high quality business that is undervalued. That's just my opinion. And in my marketplace, I've kind of stayed away from that. My marketplace, I've either gone for very stable businesses that trade very cheaply on a free cash flow multiple. I try to seek out 6 times free cash flow multiple, but that's really difficult to find. And if you find it, that's great, but I think that's quite difficult. I do that, but it can be difficult to find. On the other side, so if you're looking for high growth companies, you kind of want to really see the growth just buzzing off, and you want to see the margins at the top end, at the gross profit margins, as high as possible. So you don't want to get necessarily involved. I have done that and it's not great. You don't want to get involved with something that has a gross profit margin of, let's say, 15%. I mean, it has to have astonishing growth to really compensate, because that means that revenue is pretty worthless. It's just revenue for the sake of revenue, revenue, just vanity. So that revenue has to be profitable revenue. So you have to start thinking ideally kind of 70-75% non-growth profit margin, because it's going to expand over time as the business matures a little bit, and you might even get to high 70, touch on 80% growth profit margin. But you don't want to kind of be in a situation where it's too low. See, that revenue has to be high quality revenue that has the potential to later on translate into high free cash flow. That's what you really want. In either case, whether it's low growth or high growth, what you want to buy is a business that generates a lot of free cash flow. So we talked about whittling it down to about 30 companies, and now I found in my own stocks what I've migrated towards is businesses that have a lot of insider ownership. I believe very much that if the CEO is the founder of the business, that it's his baby or her baby, and they will most likely just live for that business and they will do whatever it takes. And that managerial style brushes off. It's like this, the Steve Jobs effect, that it just has so much passion for the business that it kind of rubs off, and people become kind of skewed into the idea that they can do more than they actually can, and it just works together. You look at Amazon, you look at Tesla, and these businesses, managers are just such cult status that they kind of just take away the whole managerial team. So just look on the proxy statement, go onto sec.gov and look at the proxy statements called DEF space 14, and it gets once a year reported together the 10K, and you can just look at ownership of the stock, and you can see if the CEO owns, let's say, at least 4 or 5%, and if it does, and that's that's great. Finally, for more advanced investors, I think that once the investor's quite familiar, and this is once you've been kind of doing this for a while, quite familiar with many businesses, I'm talking, if you kind of know more or less 200 companies, you should be looking for certain themes. So right now in 2020, one big theme that people are really migrating towards is the acceleration of the digitalization of the economy, the work from home theme. So that is something that people have really gone into, and anything that has the buzzword cloud, I mean, that's really kind of, I think that boat has truly sailed, and I think the multiples are really high there. So there are certain themes that happen every so often. It could be advertising. Advertising prices have come down, but in certain platforms, especially the social medias, there's been an offset by the number of users coming on. So themes are something that's quite attractive, and look at the peers as well of the businesses. Once you kind of get quite familiar and quite good at doing this, try to understand the peer groups as well. So today we've covered a lot of ground. We talked about thinking about screeners, whittling down the number of shares that the person's looking at, then looking at certain metrics that I find useful, getting to know as quickly as possible, looking at the proxy statement, and then we've lastly talked about different themes that investors can look out and think about. Hope you found this useful, and I'll see you next time.